Welcome back. Markets back in almost flat terrain. They have picked up most of their losses except for the Nifty Bank. But earnings season is upon us. And you just heard in detail about the IT sector. We now get you an overall preview of the earnings sector. Joining me now is Gautam Duggad, the head of research institutional equities at Motilal Oswal Financial Services. Good morning, Gautam. Pleasure having you with us. Thank you so much. Well, first, can you lay out the numbers? What are you all expecting in terms of an earnings growth in Q1 for your universe and for the Nifty?
Hi, Latha. Good morning. Thanks for having me. So this quarter basically is going to be a continuation of the trend that we have seen in FY23 as far as big sectors are concerned. Just an additional distortion this time because of what is happening to oil marketing companies, where you're seeing a substantial increase in profitability because of the marketing margins. So you have to keep that piece aside when you look at the aggregates. However, on a reported basis, we are estimating a 50% growth for our coverage universe in profits and 25% for Nifty. And as I said, if you keep OMCs aside, the growth is about 12 and 11% for Motilal Oswal coverage universe and Nifty earnings. Sectors that are doing well are the same that we have seen for last 3 quarters, which is financials and autos, which is continuing the trend that we have seen starting from third quarter of FY23. Consumer is also expected to do well with about a 20% growth, largely a reflection of margin expansion. And we're expecting about 15% kind of a growth in IT as well as pharma. IT, however, is more a reflection of low base because the quarter-on-quarter trends are going to be quite muted as far as demand and commentary is concerned. And what is pulling down the numbers are basically global commodities like metals and then oil and gas, excluding the OMCs, which are showing a big decline. So metals, we are expecting the profits to halve on a YOY basis, and oil and gas also about 20% decline ex of OMCs. So that's how the overall picture looks like. There is going to be a margin expansion in many sectors, and I think this trend will perpetuate as we move forward in the rest of the quarters in FY24. Overall, we are still talking about a 20% kind of a growth in Nifty earnings, 16% excluding commodities for the full year FY24.
Okay. The overall Nifty, you have still brought it down by about 0.5% or something. That's what your report said. Any reason why you brought down your Nifty EPS expectation, albeit very marginally?
It's not even marginal, Broadway. It's just minor tinkering, Latha. So there's a 0.7, 0.8% cut in FY24 and 0.5% cut in FY25. This is largely a reflection of what is happening in metals profitability in the Nifty profit pool. So if you look at the absolute profit numbers for Nifty that we have, we've cut the numbers by about 5,000 crores in a total profit pool of about 7,60,000 crores, within which metals profits itself has got cut by about 12,000 crores. So rest of the sectors put together have actually seen a minor upgrade. So auto has seen a minor upgrade, oil and gas has seen a minor upgrade. Banking numbers are very stable. In fact, banking is still looking very strong, despite the percentage growth now shrinking because the base is very high now. So profit pool of banks itself, this year, we are expecting in Nifty to cross about 2.5 trillion and FY25 to about 3 trillion. I mean, that tells you the scale of the profitability now because 5 years back, entire Nifty's profit were 3.5 trillion. And in FY25, your financials profit pool itself will cross 3 lakh crores. So it's minor tinkering out there.
Okay. We are going to start with the IT companies. There you expect downbeat guidance as well. You've already mentioned that in terms of growth itself, IT companies are not going to do too well in terms of EPS growth.
Yeah, it's well into the numbers now, actually, Latha. In fact, our IT team believes that there can be a minor 100 bips tightening of guidance in Infosys. The quarter-on-quarter sequential growth on a constant currency basis is also going to be muted in tier 1 companies in IT. And there are some companies where we are actually expecting a quarter-on-quarter decline in the dollar revenue growth. So IT demand patterns are still very weak. Decisions are getting deferred on projects. And discretionary demand is also coming down there. So what you're actually seeing in IT is basically cost efficiency and vendor consolidation projects taking precedence over the digital transformation projects that we had gotten used to in CY 2021 and 22. But I think as the scenario gets clear over the next 1 or 2 quarters, these companies can come back because they've seen many such cycles in the past and valuations are already looking quite attractive. as far as large cap IT is concerned, because the NSE IT index has been underperforming since the beginning of CY22. But yes, the
Fair
quarter
enough.
is going to be muted for them.
Yeah, 16%, I think, earnings growth, according to your table. Well, Gautam, what about, banks? Your note seems to indicate that while you're expecting all banks to do well, your preference for buying is going to be PSU banks now.
Absolutely, Latha. That has been the preference for last 1 year or so. And in fact, in our model portfolio revisions, we've further increased the weight in PSU banks. So we had added Bank of Baroda a year back at 86 rupees in our model portfolio. Now at 200 rupees, we further increased the weight from 2 to 3%. The reason is very simple, Latha. In fact, this quarter also, if you see, while we're expecting a very strong 30% plus profit growth in private banks, we're expecting the profits to double in PSU banks. However, you have to keep one thing in mind when you are looking at financials numbers now, because quarter on quarter now, the growth will moderate. PSU banks will have 1 or 2 quarters more of a low base benefit, but private banks already you will start seeing numbers getting a bit more moderate. In fact, for the fourth quarter of FY24, we're expecting the PSU banks to report just about 10% profit growth and private banks to report about 12% profit growth. But overall, valuation, growth, balance sheet, ROE, overall asset quality framework, if you see, there's no doubt in my mind that the sector deserves to have a big overweight. And that's what we've done actually.
Okay.
We've increased the weight in NBFC further in Mahindra Financial, which we had added 2-3 months back. The stock has done actually very well. It's up 50% since when we added in April. And our conviction remains quite high there. So we've increased the weight further there. So financials and consumption are two sectors where we have further increased our overweight stance and increased it in a very big manner.
Okay, and you, besides MMFSL, you're also adding Piramal, I think, to your portfolio. So NBFCs are going to better than banks?
I think so. See, because in NBFC, it's slightly more of a tactical and alpha trade. And post-April, when it became clear that RBI is going to pause on the monetary tightening, it augurs quite well for NBFC from a trading point of view. And that is when we started increasing weight in NBFC. If you see the end quarter disclosures of many of the NBFC companies you come in, the AUM growth, disbursement growth, I mean, you've seen the disclosures of Bajaj Finance, you've seen the disclosure of Mahindra Financial and a couple of other names. It's pointing towards a very strong quarter. In fact, in NBFC itself as a pack, we are expecting a 30% profit growth. And plus the fact that rates are going to either remain stable or ease at some point of time, it does provide some sort of a cushion to NBFC valuations. And despite the run-up, in NBFC, you still see some room for upside out there. So which is why we are tactically raising the weight in NBFC further. And in some cases, where the stocks have run up a lot, we are also using the opportunity to reallocate money. So for example, we'd added Poonawalla, I think 6 months back, and the stock is up more than 50% there. So there we have replaced it with Piramal. So some of those tinkering and trimming and reallocation we have done in the model portfolio, but overall, the view remains extremely sanguine on NBFC.
Just today, or maybe this week, it's a little not very easy to believe that interest rates are going to go down. We have seen a 20 basis point increase in interest rates over the past 2 weeks. If you only looked at the bond market, clearly led by what's happening in the US. But I take your point that RBI cut is not expected or a hike is not expected. Gautam, will the mid-caps wow? Because we've seen a very strong run-up in mid-cap stocks in the past, in 2023 itself, 19% was the index rise. So do you expect a wow number in some of the mid-caps? Can you alert us to which ones?
So Latha, while a lot is being made of the recent 20% move in the last 3 months for a mid-cap and a small-cap index, if you take a step back and look at the overall performance of these indices over the last 5 or 6 years, the small cap index is compounded at a measly 7%, whereas the mid cap index 5 or 6 year compounding is just 12%. It's because of the last 3 months of the rally, it seems that there is a lot of euphoria. But the fact remains that over a long period of time, at least in the recent past for last 5-6 years, the returns have been abysmal. Now, coming to your question on mid caps and small caps, they are always a bottoms up trade. You cannot basically categorize them sector by sector. So in every sector, you will find ideas where some mid caps and small caps will fly. For example, in hotels, we are expecting very strong numbers, which is why you were seeing two hotel stocks in our model portfolio for some time now. Real estate should have a very strong quarter once again. Something in the consumer discretionary, you have seen the numbers of Titan as well as Kalyan, right? We've in fact added DMart in our model portfolio. We've added Zomato in our model portfolio. So a lot of these sectors will have some segments of mid caps where numbers will look extremely strong. But again, you cannot categorize them in a basket of a sector, because every sector will also have some mid caps and small caps, which will disappoint. So you clearly have to take a more bottoms-up view when you are looking at mid cap and small caps. But yes, I do believe that a lot is being made of the last 3 months of a rally. If you take a slightly longer-term picture, the returns of these indices have been quite average.
Okay. Well, just one final question. A lot is being made about power and smart meters lately. We hear that conversation. You're not swayed by them, not adding those companies?
Unfortunately, right now, we don't have a coverage on them. But yes, manufacturing and overall infrastructure thrust that the government is giving, and again, the recovery in the private capex cycle that we have seen for the last 2 quarters, we expect that trend to further reinforce going forward in FY24 and 25. And therefore, there will be a lot of subsegments of renewables on infrastructure side, on overall capex side, which will come back into vogue. Some of these spaces or subsegments have been completely absent in the investor conversations for almost 10 years. They've come back into vogue only in the last year and a half. And I expect that the private capex cycle to strengthen even further from here, and will open up a lot of opportunities in many of these unique and niche subsegments. And therefore, it makes sense to have a slightly higher allocation towards manufacturing and capex side of the overall portfolio.
Okay. That's an excellent overview you have given us and prepared us for the upcoming earnings season. Thank you very much, Gautam Duggad, for an extremely comprehensive report that you have presented. Excellent report, must-read report, and of course, the numbers there. And wrap up on Bazaar on that positive note. Chartbusters up next.